guys, and glad to have you on board again today. Will we have enough volatility to keep up doing those things throughout the summer is very tough questions. I'm still trying to figure out an answer right now. It's still complicated. I'm gonna try doing this thing anyway, even though volatility levels still don't really want to move anywhere. Neither breaking the support and give us the answer I'm looking for, whether or not I should take some vacations and get back to work early September, or whether or not we're going to have volatility rebouncing out of these areas and therefore creating quite some more interesting context for the intraday purposes, which we talk about in here, because just like we will do on those daily updates, we'll try taking care of both the time frames of swing updates if we're dealing with areas that matters, and that will update our weekly plans, the ones I release each and every weekend, but we mostly will focus on lower time frames, which means in those weekly updates we take care of everything that goes down to 4-hour, 1-hour charts, right up to daily, weekly. And of course, on the lower time frames updates, the ones we do on a daily basis, we'll mostly take care of anything that is closer to 15 minutes and eventually even lower time frames if we do not have anything to trade on the 15-minute. But 15 minutes is going to be like our reference time frame for those daily updates. All right, anyway, let's get right into it and make our context analysis. And here we're going to use slightly new changes on this thing, but this is not really a game changer. You'll see about it. So first of all, we'll have a look at the daily economic calendar, major news. This is only news based on US. We're only going to cover the SPX in here, even though this is not necessarily the most suitable asset to trade right now. This is the one we're going to be talking about because I would like to get a consistent type of analysis. So instead of changing asset each and every day, trying to be more of an opportunistic approach, which should be definitely the most profitable right now, I mostly want to be on a deterministic approach, showing you how to build scenarios. And therefore, I'd like to have and deal with the same asset every time, each and every day. So you get consistency and repeatability of the processes each and every day. So you get to use the mechanic on your own. So of course, what I'm doing in here is just not a financial advice. It's just showing you how it works. And you can obviously repeat and do this thing on every other asset you might be trading. So do this thing with the assets you trade. It's not just getting out there being fed up with someone talking about the SPX if you don't give a shit about this asset. Regarding the major news yesterday, the leaders have been leader headlines basically have been all about gold making new historical highs, and it definitely has been something. It's major moves on the dollar that is going on. We've broken through significant levels on all the things that prices against dollar, just not the stocks. The stock market right now might be the only one that is still lagging somehow behind because we tried breaking resistances, and we'll see all about it. So it is still a very tough question. Is this a big trap? And in that perspective, even gold will try breaking resistance and heavily pull back afterwards, just like EUR/dollar eventually. But there is also the perspective in which we accelerated, triggered very big time frame breakouts, and in that perspective there's still a lot of moves to come. We just might be getting started with this thing. That's my personal assessment out there. So anyway, we're going to keep on doing this and playing this game, just like I told you yesterday on the crypto update. It's basically, I don't know shit about what's going to happen about the dollar. It's just that as long as it goes on, I'll consider it something that is probably going to keep on going as well. So it is a little bit parabolic. It is clearly oversold right now, but that doesn't mean it's going to reverse. So as long as it goes on, let it go. All right. Then we go fear and greed index. That is new, but that is something that we're going to keep because it's absolutely necessary for us in the analysis. Greed is at quite some higher levels. We're not at the high. Clearly nothing close to what we were previous back in the coronavirus, on the pre-coronavirus era. Obviously, you can see the huge changing from totally over optimistic levels, extreme greed, like levels we've never seen for decades, down to extreme fears and levels we've never seen, of course, for decades as well. So we're going historical volatile behavior in here, and what we can see is that we're sitting in between in here, pretty positive in here as we are obviously on top of 50, but that doesn't necessarily mean that it's going to last very long. So my question right now is still the same. Are we going to get significant levels of volatility or rebouncing that will allow us to shift the sentiment below 50, which would be totally appropriate after such a washing machine structure going up and down? So in terms of sentiment, still positive, but not crazy positive as it was before, and we're certainly not going to go close to anywhere beyond those levels. So I suspect we're going to be oscillating within 70 and 30 in the future, and probably for multiple months. So sentiment has been hit very hard, and investors don't really know what the fuck they should be doing. That's also my personal case. So that's the reason why lots of hesitation, probably lower position sizing for professionals, and in the same time, still the same problem. Retail traders getting leveraged in the market into things they don't really understand, and they're taking heavy amounts of risk, creating crazy bubble here and there. So still the same context. Very dangerous, because we do have smart money really being not knowing where we're going, and in the same time, retail traders thinking that they know what the future is with 100% certainty, which is nothing close to risk management. Okay, quick look at yesterday's sessions on the indices. Definitely the same old stupid game at play. As you can see, this trading session has been cut down in half. First part was pretty much hesitating. All along we had the European session, basically, because it has been the switch. As we got to close the European session, market bottomed down and managed its way right up to close the session at the high points. Totally stupid type of trading coming from the Nasdaq as usual. So still the same old assets that have been bought after we closed the European session. All right, so it was very understandable session. Risk taking totally from the US. So they basically want the euro area closing at the low points, and then risk taking to force gapping up the day right after. So we'll see all about it later on, but it is all about this type of process. Quick look, of course, at other asset classes. We can see that everyone has been trying to break a resistance and somehow failed pretty epically. Just not the Nikkei. The Nikkei is pretty much died and dried out of any type of volatility for now more than a month. Other assets have been like EUROSTOXX and DAX trying to break the resistance, failed and reintegrated. So big question right now, is this just a pullback, loading up some buyers before actually breaking and holding below, above this level, or is this really an end of trend type of trap in which people break a resistance that we're not going to be sustained in the future? And in that perspective, pulling back to support and breaking the next support seems the most probable outcome. In terms of VIX, it is obviously as stupid as it is. We're still sitting on top of this previous support that we tried slipping below, but totally failed as we tried and gapped up right after. So now, same big question out here. We're dealing with the levels we've prospected for the weekly updates. So are we going to break through trendline resistance? And in that perspective, how high can we actually manage to go? Or is this just pullbacking of a trend line, bearish trend line, of course? In that perspective, are we going to break this support later on? Still very tough question. It's all about volatility nowadays, and it's really stupid, of course, but that's the world we live in. The treasuries, we're going to have a quick look at that, because I think it's really important when we are actually trying to frame the market and risk managing perspectives and stuff like that. So we have a look at the entire yield curve coming from 30 years to 2-year, and definitely see that there are totally different ways of seeing risk, whether it's a real short term or call it short term for 2 years to very long term 30 years. What I care about in here is to have a look at the 30 years most in here, because it is the one that might be giving us a pre-signal that we do have problems down the corner with Fed printing so much money. So it is eventually going to give us an early signal for dollar going too far, and in the same time indices probably suffering quite a lot, because now if we do have rebouncing on the dollar, we're going to suffer from both the monetary basis deteriorating and the dollar rebouncing. That will be absolutely a big problem for stocks. So we're going to have a look at this on a daily basis. How is the 30-year responding? If it's actually breaking supports and accelerating to the downside, we might have a replica of the first shot we've had through June. And if that's what's down the corner, not going to be pretty. Okay, because that could lead to quite significant levels of volatility by investors betting against the Fed being able to sustain such a thing for 30 years. So which means the 30-year yield curve will start to reverse, and probably afterwards 10 years and 5 years might be following. And in that perspective, not a very good deal for the Fed. Keep on going. Quick look finally at forex. So this is exactly what we told about. This is just over 1 week. We can see that the dollar is losing ground against every other currency but the CHF. And basically, this is just right by Monday. So this is quite significant levels for just 1 day of trading. So following on from what's happened last week as well, we're all seriously losing ground in terms of forex and dollars. So right now we do have a lot of monetary-based assets movement that has been happening into cryptocurrencies, gold, silver, anything that is pricing against dollar has been moving quite harsh and violently recently, but not the stock market. So this is still a very concernable movement that we see in here. Instead of seeing stocks surging to the upside, we see stocks quite ranging. So this is still a big question mark. Anyway, now it's about time to get to the charts and make the actual forecast. All right, so here's what we got. I'm going to try putting myself the arrows back in place, but it's going to take a little bit of time because it's a trick I'm going to need to put in place. So anyway, in here, quick look at the 1 hour chart time frame in which we're going to make our context analysis, all right, seeing where or not there are technical areas in which we need to be doing some specific things, like where do we need to not buy and not sell, because we're getting into swing territories. Okay, today it's going to be real simple. The areas in which we must not do one thing or another are really simple. We're going to be dealing with, it's absolutely forbidden to try selling if we get closer to this support, because we're going to get into the support context. Even though this support context is orientated to the downside, we can also see that moving averages are moving to the upside. So quite a lot of support and potential support into those areas. So as long as moving averages are going up, even if the trend channel itself is going down, that doesn't mean the market is bearish. That simply means the market is hesitating and therefore favoring probably ranging context right now seems a lot more appropriate. What we can notice as well is that we had some downside breakouts and the market managed to go right below. So totally suggesting, I personally think that this is a ranging thing more than anything else. Yesterday was quite an opportunity for the bears to really push this down. They somehow failed, which leads me to believe that deep retracement might be expectable. For huge resistance, it's of course getting into the resistant context. If we ever reach out to those areas, that means it's totally forbidden to buy. It's going to be a selling only activity, and probably for more swing traders than intraday ones. Anyway, going 15 minutes right now, so learning about the areas we've highlighted. All right, this is the area in which nothing can be done of buying or trend following. You don't buy, you don't trend follow into this area for the daily chart, for the 15-minute charts and the lower time frames. Just like getting into this area, which is where we get huge supports, you don't sell. Okay, so today feels like a very simple session to navigate. It's mostly going to be due to volatility. So it's all about waiting for volatility to actually show up something. And what's staggering in here is that when I know and when I see this, I can tell you that I'm totally probably going to be picking the right scenario today for a simple reason. Just have a look at volatility all by itself. You can see that the Bollinger Bands are contracting and they're totally highlighting the areas we've seen. So when you see volatility lining up with trend channel analysis, generally means that you're definitely getting a range. So I would wait and say that today, for swing trades or reversal type of trades, this is going to be into the swing areas. And this is going to be trades to trigger on the 1 hour chart time frame or 15-minute chart, but to hold for longer time frames probably. Okay, for purely intraday trades, I suggest you trade the trend channel in here. So big question mark right now at the European Open. What is it going to be looking like in terms of the European trading session? Just like we've seen yesterday, a US session has been split into two very significantly different parts. The first one has been closing the European markets as low as possible, and afterwards lining up the gains to where the US daily candle close. So it really has been sending a message to the euro area. How are the euro traders going to take it today is a big question mark. Whether we're going to deteriorate the signals and totally invalidate what happened yesterday in terms of price structure, we can definitely see that it has been going on in two sets of waves, and therefore not the best case scenario, because in a range, going two sets of waves means if we ever break this support, means we terminated the retracement. We barely got to 61%, which may lead us to building new lows. Okay, working out this area and probably pushing lower in the future days. So if prices start to deteriorate, there are furthermore downside to expect later on. If prices somehow manage to sustain into this area, eventually even breaking this trend channel, but not getting to the context, that would probably be a pullback opportunity trying to push toward the next resistance. I don't know, clearly I don't know which one of those two are going to be opted for by the markets. All I know is that I'm probably not going to be trading the European session, but trend follow the movement we had on the early trading activity. Probably US are going to try following what the European does. So Europeans are going to be deciding whether up or down, and they're going to give us quite some early signals. So trading right this morning is not really going to be profitable. I think waiting for midday session for the European sessions, and in that perspective, we'll have early information on whether or not the Europeans want to orientate the session today. They probably may not give an answer at all, and in that perspective, we'll still be there half day, not moving out of this really 50-50 game. As you can see, interesting prices are fairly much equal distance from current prices, which means if Europeans simply don't want to do anything and call it for a draw, we'll stay there and do nothing earlier today. That's the reason why I think the European session might be totally uninteresting in that perspective. All right, so you've got the technical levels. Technical levels are really all about right now whether or not we're going to manage to retrace back to the context, and if whether or not we're going to manage to get to the trend channel in here, and whether or not we're going to break this trend channel in here and manage our way back to the context. Anything in between in here can be supportive. So you've got lots of historical horizontal supports in here that you can act as. So you could eventually consider 32.25 as a potential supportive area, but if this one breaks down, I think that there's no other ones down the road. So it's really all about 32.25 potential support in here if the market goes down this way. But if this support doesn't work out, or simply work out but be broken down afterwards, I think there's no other options but getting into the trend channel, the context channel in here, and it's probably going to be broken. And in that perspective, yeah, bearish range probably down the road. All right, that being said, I wish you guys a pleasant day. I want to keep those things being as short as possible, because that's much that is going to be all about it. I mean, keeping those things approximately 15 minutes. So today we're just 2 minutes off the table in here, but you know I'm the talky kind of guy. So that being said, I'm going to leave you guys with this. Have a nice trading session. Don't be too aggressive. Wait for interesting prices. Once again, make sure you validate the structures, make sure you validate the context before getting into market trading. Never trade because you want something to happen. We're dealing with very low levels of volatility, so it might take quite a while to actually get to those tradable areas. And in that perspective, don't try to force it. That doesn't mean, if the market is not really moving right now, that doesn't necessarily mean that you have to narrow your expectations. So really build your plans and wait. And waiting in here can be a real pain in the ass. But don't forget the two very, very dangerous nightmare biases. The first one is you trying to understand the market. You don't, and you never will. Don't get me wrong, in here I've been doing this for years and I never ever go close to understand anything. So not understanding biases, just don't go down this road, and don't go down impatience biases. So like I said, sometimes waiting is absolutely necessary in the low the volatility, even though it might sound totally stupid to you. That's the reality we live in. Don't try to fight it. All right, embrace it, and see you guys tomorrow.